Perfect.
Here.
Great.
Based on the miking situation. Hello.
That's not my water. I shouldn't. Okay.
We have a luxurious half an hour here. Hi, everybody. Thanks for coming. And thank you so much. So, I was going to start off with a little bit of a surprise for you, which I hope you don't mind. But so this is kind of an amazing thing. Zach you basically launched Plaid at a hackathon at Disrupt.
It was our first publicity that we ever got.
It was the first publicity you ever got. And I think you blindsided TechCrunch so much that they didn't even realize you didn't exist already. They talked about Rambler, and they just sort of slip in the Plaid API.
Yeah.
It's amazing. So basically, as if it existed. And so much so that I was like, what? Wait a minute. I was reading back on it and thinking, I guess we've covered him before or something. Nope, nothing. That was actually the first mention of it.
Exactly.
So I thought it'd be quite funny. Can you guys put the slide up, please? It's so cute. It's you and your two co-founders. Are we going to get it up? Can we get it up,
Oh, there
please?
it is. It's over there.
Where is it?
On that side.
Oh, we can't see it. All right, there they are launching.
Oh my gosh, my hair was a lot shorter back then.
Oh, there we are. We can see it down here.
There we go.
Look at you guys. So you're there with William and with...
This is my co-founder, William, on the right of the photo, and the person in the middle is Michael Kelly.
Yeah, Michael Kelly.
He was actually joined us as an intern. And I think he was actually an intern that summer when we did the hackathon.
So he wasn't a co-founder in that picture either.
No, but then he was with us for a really long time, an amazing leader, and
I think it's just so adorable. Okay, you guys can put it down now. Thank you very much. Thank you.
This actually.
Oh, no, keep it up. Wait, put it back. Put it back.
We don't need the photo, but
yeah.
It was interesting. We'd known what we were building at Plaid for a while, and we'd kind of created this API, and we'd been talking to some people about using it, but the reality is no one knew what it was or how it worked, and the concept of building something in financial services was pretty foreign to most people. This was the time. This was, I guess it was 2013 that we did the hackathon. And in 2013, the VC zeitgeist was don't invest in financial services, don't invest in fintech. That market is not going to go anywhere. It's too regulated. The banks are going to do everything. There's too many big incumbents. It's not going to grow. And so we'd built this fintech API, believing that the VC zeitgeist was a little off.
Yeah.
And yet we still couldn't. We had no publicity. We had never gotten anyone to build more than kind of one or two small projects on it. So we went to the Disrupt hackathon. And
you guys travel. You were in New York at the time, though. That was in New York, I think, wasn't it?
Yeah. So we actually started the company in New York.
Okay.
So we were still living in New York, but we were in the middle of moving to San Francisco.
Right. Okay. That's where you had to be at that time.
Exactly.
There was no way to start a company, especially like that, anywhere.
That's very true. So anyway, so we go to this hackathon, and kind of an amazing experience. We ended up building a product from 0 to 1. It's called Rambler. Everyone thought that Rambler was like going to be a company and something that we were going to go start, but we always were saying, hey, we're wearing the Plaid shirt. We say, hey, we're building a thing on the Plaid API. Can I tell you what the API is? And during that day, I walked around and talked to, I think, every engineer in the room to tell them, hey, this is what Plaid does. This is where we're going. You should maybe use Plaid in your product. And most of them were kind of like, hey, go away, leave me alone. Unless you have pizza, I don't want to talk to you.
If you're not from Foursquare, we don't care.
Yeah, exactly. This is when Foursquare had the best API that was out there. And it worked, though. We got a lot of attention. We got some new customers out of it. And I feel like when you're early, you just have to do those scrappy marketing things.
That was incredible. So Rambler was never meant to be the product.
No. Rambler was a product that we built on the Plaid API as a demo.
A little app as a demo.
Exactly.
Right.
And the coolest thing was it was a magnifying glass that just moved around this map as you were spending money at different places. You could actually see all the places that you went and spent time, and it was like this walk down memory lane for people. But we came up with the idea, I think, the night before. We got there the morning of the hackathon, started writing code, and 24 hours later we had it.
Incredible. And I don't know what that says about TechCrunch, that A, you won the hackathon on Rambler, not on Plaid. B, one of our reporters, whose name I will not mention, but he now works for the Washington Post, wrote this whole story as if he completely was on board with what Plaid API was. Had no idea. It's so funny.
We snuck it in.
I love it. He just like faked it till he made it.
Exactly.
So yeah, very amazing. And then of course, it wasn't too long after that. It was like the end of that year. You raised your first funding.
Yeah. So we actually had 2 funding rounds. So we started working on Plaid in early 2012.
Yeah.
And originally, we thought that we were going to build a consumer finance application, so something like Rambler. We started out building consumer budgeting tools, consumer expense management tools.
Yeah.
We built a tool to help consumers figure out where to spend less money. Similar type of store you could go to, but cheaper. It turns out all the products we built were focused on telling people to spend less money.
Yeah.
And when you build a consumer product that just tells people to do something that they don't want to do, one of the natural reactions that I guess we should have thought of is that they just stop using your app. So pretty quickly, we would build these products, we'd launch them, and no one would use them. And so we learned a few things. One was that we just didn't understand consumers well enough to build great consumer products.
Yeah.
The second big thing that we learned is, integrating with banks was really hard, and the back end for what we'd built was integrating with banks. So we ended up turning the back end for our product into a company itself. And we found, so many great things. Mostly that we could affect so many millions more consumers eventually, by building this infrastructure than the one app that we'd created. And so we actually, along that journey, we'd raised $60,000, which kept us alive for about 18 months. And that's like a real shoestring budget. We were living in New York, and that was difficult. And then, at the end of 2013, we raised our first actual round of VC.
Actual round, yeah. And then it just sort of really took off after that. And I won't go through all your funding rounds or anything like that, but you were picking up really impressive investors. Andreessen came along, and that was nearly like, that was it. You guys made it after then.
You're describing something that sounds like an easy story and like goes all up and to the right. It turns out not quite like that.
But you were kind of jumping into the whole API game, like at a time when it was really just hitting the ground and really picking up momentum. You've had Twilio and Stripe, and the whole kind of like API business was suddenly a thing, and it hadn't been really before then. And suddenly it was just like the jargon that was on everyone's tongue. That was it on everyone's lips. Okay, fast forward a mere 7 years later, and Visa is knocking at your door, offering like $5.3 billion to buy you guys, saying that they wanted to buy you as an insurance policy because they were so worried about what might happen with their debit business, which is like fully, I think, justified, because I think that is going to be the end game with how a lot of open banking stuff works. But so going back to then, obviously you're not acquired by Visa. You did not get bought by them. But going back to that time, how was that? Can you talk to me a bit about when they came knocking? Were you like, absolutely, we want to go to this. This is Visa for crying out loud, or like what was your sort of like, thinking, or did you think we shouldn't get acquired? You guys did accept the offer, so talk to me about it.
Look, I think one of the hardest, probably the hardest decision that an entrepreneur has to make, kind of in the arc of their company is, should we sell the company or should we not sell the company? And I think most successful companies will have the opportunity to sell along the way, some multiple times. For me, this was certainly the hardest decision that I made as an entrepreneur, was deciding to sell to Visa. And there were some really good reasons to sell. It's a great platform. We were really focused on international and scaling international. Visa had amazing products. They had great distribution, amazing relationships with banks. There were so many logical reasons. Plus, the price was a very good price.
It was double your last Andreessen valuation.
It was,
so it was very good,
It was a very good price.
Yeah.
There are a lot of reasons not to sell, though, as well. So as an entrepreneur, you love building your company. There's the personal reason. There's also the business reason. We could potentially have built a bigger company independently. We went through this intense debate. I actually remember I invited our entire leadership team over to my house. We were sitting in my living room here in San Francisco, and having this debate. And there was no clear answer. There's not consensus. Some people were on one side, some people were on the other side. And the rationale for it was definitely all over the place. But at the end of the day, it was my decision, and I made the decision to sell. I thought it was the best thing for the business, and most importantly, the best thing for the mission and for our customers, for us to scale within a larger platform. It was one of those 51-49 decisions. You could see like both were amazing options. We made the decision to sell. We thought that was the right decision at the time.
Right.
And indeed, if I'd gone back, I still think that was the right decision at the time.
Okay.
But the reality is the next 12 months changed everything for us.
Right. So of course that was just before COVID hit.
It was.
Then COVID decimated everything, and it changed pretty much how everybody did everything, including how how people were banking and doing any purchasing of anything. It all suddenly went super duper digital, right? Of course, the decision on the Visa thing was out of your hands because Visa walked away from the deal over antitrust issues with the Department of Justice. How were you? Were you relieved? Were you like, oh crap? Or where were you there? Take us to that time.
So it's a little different than the way you phrase it. I'll share more. But basically what happened is 2020 announced, I think, around the 10th or 15th of January, we're going to sell the company. Announced to the team, we knew we'd have to remain independent, continue to focus on what we were doing until the transaction closed.
Would Visa have let you stay independent?
That was what they told us, yeah. So
Yeah.
they said that we were going to run as an independent entity. Everyone still rolls up to me, kind of a piece within a larger whole.
Yeah.
But they, so you start off and kind of kick off the team focused. Some people are excited, some people are hesitant, but overall people are supportive of the direction. Then COVID hits, and this was March of 2020. And over the next 4 weeks, the market just falls apart. Everything crashes, and we're looking at our deal that we've set up. It's an all-cash deal. There's a provision in it that says Visa can't get out of it, even in the case of a pandemic.
No way.
Who would have thought that a pandemic clause would ever come into
That's something a lawyer
effect?
puts in,
Exactly.
assuming it will never, ever have to be tested.
And so we feel like we're geniuses.
Yeah.
We've just done the best deal. The market's crashed. We've got a price locked in on the pandemic clause, and if this thing closes, then we'll do really well. And then people start to react. So financial services is looking at this concept of how do I serve a consumer when they can't walk into a bank branch anymore. And everybody doubles down on digital. So all the banks say, hey, we're taking our 3-year digital roadmap, we're going to do it in 6 months. Our customers say, we've never seen this kind of growth, we've never seen this kind of demand for online lending. People still need loans, even though they can't go to a bank branch. And so we saw this huge acceleration of the business. The market started to turn, and along the way, the DOJ kind of went through its process. So the DOJ was investigating Visa for antitrust, nothing to do with Plaid. It's really on the Visa side.
Yeah.
And first they said, we're going to do the first look, then they did a second look, then they kind of gave us these signals that it was going to take quite a long time to stay in it. And the reality is we could have stayed in the transaction for a lot longer, but when we got 12 months into it, our business was very different. We'd had this massive growth, we'd had a huge brand moment from Visa kind of announcing the deal. And our team had evolved a lot, and we'd stayed very focused. Our product suite has expanded. And so kind of end of 2020 and early 2021, we had the same meeting that we had. But this time it was during COVID. So we had the doors open in my living room, and some people still met in person. Some people sitting outside, some people sitting inside, all the windows open. Masked, yeah. But it was the same group of people sitting around the table. But this time the decision was unanimous that we wanted to walk away from the deal.
Oh, you guys walked away. I always thought Visa dropped it because of the DOJ.
Yeah, so we chose to walk away. We worked closely with Visa on this. Ultimately, it became a mutual decision, which was where we wanted to land it. So basically that time the discussion in the living room was unanimous. Everybody said, we want to walk away, we believe the company's better independently. And then started the hard part, by the way. The next 6 months were the most sleepless 6 months I've ever had, because you have to get everyone at the company refocused on the mission, the independent path, where we're going, all that stuff. Of course,
but that was a really heady time. I think that everything was about digital, this and that, and nobody was even thinking for a second that there was anything around the corner that wasn't anything but pure growth, so Indeed. Maybe it wasn't too hard. But so what's interesting to me is, did you guys already have investors approaching you guys to give you funding were you to walk away from the deal? Because it wasn't that long after that deal dropped that you announced a big funding and a big valuation. You suddenly went from, you didn't triple, but you nearly tripled. You went from $5 billion at Visa's offer to over $13 billion with your last funding round. So tell me, was that like something you guys had in your pocket when you walked away, or was part of that scramble like, shit, we need money now because now we have no runway?
We were actually fortunate. We had a lot of cash coming. We had a lot of cash coming through the deal. We had a lot of cash going into the deal. We had a lot of cash when we exited the deal. And the business it's very efficient business.
Okay.
So we weren't burning very much. Actually, I think at that time we might have been cash flow positive. I don't remember the details at that point. But no, we didn't make the decision with a funding round in hand, but we were confident if we needed to raise funding, if we had the opportunity to raise funding, that it would be there. We made the decision because we believed in the mission, we believed in the team, we'd seen the evolution of the market, and we'd seen the evolution of our products. And it was just a bet. We wanted to bet on ourselves. We kind of knew the path that we wanted to go towards. But yeah, we did come out. We raised a big round of financing, brought on board some amazing investors. We feel very fortunate to get to work with them, and it's been a whole lot of focus since then.
Okay. Well, so listen, I feel like the whole visa thing was very interesting because it kind of gave a taste of like Plaid exiting, maybe to your investors, maybe to you guys, even though you decided not to. Then you raised the money, and I believe that there was then started to be, that was definitely when the IPO window was, open, and when it was, thanks, Zach, thank you. It was open, and I think people were even saying, round en route to IPO and all of that stuff with you guys. Okay, let's fast forward to now.
Well, the number of people on Twitter that would tweet at me, say, hey, join this SPAC, join that SPAC.
Oh, God.
You're going to have to set a filter for anything that says
Thank
SPAC.
God. Yeah, the SPAC were bad. But yeah, I'm glad you guys didn't do that. That's bananas. Okay, so fast forwarding to now, of course, the market has not been that kind to companies with large valuations, who are pre-market or even have gone public. The IPO window has closed. What is all that, like, how does all of that figure in your head now? Where are you guys on that?
So the short answer is we try to stay focused on the things that we can control, and we try to be responsive to the things that we can't control.
Yeah.
So I like to say, within the company, our job is not to predict the future, but our job is to react really quickly when the reality on the ground changes. And so in terms of our valuation, we don't comment on it, but frankly, we don't know what the valuation actually would be. We know what the internals of the company are. We understand the product suite has expanded. We understand the relative growth rate that we've seen year on year has continued to stay really high. And we've seen that the market continues to grow, and it goes from being just focused on digital finance. So we use the term fintech generally to refer to things like neobanks or kind of these other non-bank digital products. That said, it's gone from being just that digital market to being the banks themselves really jumping in a big way and building financial services products, and increasingly seeing a lot of the large enterprises, both tech-enabled and non-tech enabled, launching financial services products, be that embedded lending, be that bank-linked payments, be that so many other types of products that we're seeing people launch. And so what we try to do is kind of tune out the noise, and hopefully, eventually as we enter the public markets, we'll say the same thing, tune out the noise, just focus on the products, focus on the things we can control, and make sure that we're serving our customers in the best way that we possibly can every time.
Okay, so you guys are not talking or thinking about what is the next step then?
No, not in the short term.
Okay.
I would say we think a lot about what's the next step for the market, for our products, for our customers. But in terms of raising another round or doing an IPO, the reality is we're fortunate to be in a really strong capital position. We've always operated from a position of capital strength, and we're just focused on the product and our customers these days.
Okay, so last year actually, in an interview, I think in TechCrunch, or maybe it was somewhere else, somebody at your company, not you, maybe your CFO, said that there were 4 years of runway left at the company. Is that accurate? Would that make it 3 years now? Because you haven't raised any more money.
We've not raised more money, but
no, you haven't raised any money since the valuation.
We have not.
$13 billion.
The reality is we have quite a lot of runway. I don't know the exact number, but our break-even target is relatively soon, so it seems unlikely that we'll ever need more.
So you're unprofitable now, but you're already, you can see the pattern.
We are close, yes.
Okay, good. That's awesome. Okay, so does that mean that you're probably not going to be raising any more funding, or not for the foreseeable, or?
We don't have any reason to raise funding in the foreseeable future.
Yeah.
I can't predict what happens 2, 3, 4 years down the line, but not in the short term.
Nor is anyone potentially knocking at the moment. Not because you're not a great company, but because nobody's giving large amounts of money these days.
It's interesting. It does seem that many aspects of the late-stage funding market are starting to get more active.
Okay.
I'm not going to comment on people reaching out to Plaid, but we are starting to see some of our customers raise rounds, put together good financings. We are seeing some late stage kind of public markets investors still doing a little bit of privates. And then the early stage market, as you know very well, is going quickly.
Yeah.
What I've been really inspired by is the level of innovation that we've started to see as late stage markets were really stuck and not investing for about a year. The amount of small dollar but still high volume checks going into early stage startups, it gets me really excited about what the next wave for fintech is going to be.
Absolutely. Although sometimes it does feel like low-hanging fruit. So like it's just like you can see the funding happening, and you just think it's easier to give five. I mean, from my perspective, the amount of pitches we get about fundraising rounds that are like sub 10 million have really gone off the charts. And we didn't. And it used to be.
I think it's a great thing. So.
By the way, I do too. Yeah, I think it's healthier. I mean, I think it's just, when it's all too overvalued, it just feels like it's completely unsustainable.
Maybe a busier inbox, but
yeah,
probably.
I don't like my poor inbox. Yeah. Okay, so something that happened that I think probably helped your economics and the way that the company operates in terms of profit and loss has been like not a great thing, which is you guys announced layoffs last year. At the end of 2022, it was like 20% of your staff. Now, I think that from what I've read at the time, it sounded like quite a bit from your engineering team had to go, and so on. Tell me how. Maybe you can just talk a little bit about like how a company like yours in hyper growth mode, kind of needing, as you were saying, after the Visa deal, everyone pull together and really go for it. How do you do that when you've had to lay off 20% of your staff?
Well, like I said, that selling a company is the hardest decision that an entrepreneur ever makes. Doing a reduction in force is probably the second hardest decision, and for me, it certainly felt that way. As I said, as a startup, our job is to do our best to predict the future, but also be realistic with the realities on the ground. When we were kind of entering 2021, this phase of rapid growth, the thing that all our customers came to us and said is, I want to go international. Help me go from the US to other markets. I particularly want to go to Europe, but I want to be global. And in 2022, as the market started to turn, that sentiment on almost every fintech customer changed. They said, I don't want to go global anymore. I just want to double down on the markets that I'm in. I want to be sure that I can serve my customers there, and I need to focus on profitability. And for us, we try to be responsive to our customers. Now, maybe we should have been more skeptical about what they were saying, but we built a very substantially sized European team to do a lot of expansion there. And the decision that we had to make was to actually reduce that size of the European team. We still have a team there. We're still focused on the market, but it's dramatically smaller than it was before. And so, in terms of the teams that were impacted by this reduction, it was across the board. It was all the teams that were in Europe, and some of the support staff as well that was related to this expansion. And so, I deeply feel for those colleagues. We did our best to make it the smoothest transition you can possibly make. The reality is it's never a smooth transition, and it's never an easy process. But coming out of it, the team understood what was going on because, again, it's responsive to our customers, it's responsive to what we're seeing in the market. And I've been energized by how the team has kind of taken that very seriously, but also moved on to think about what's the next phase, what's the next focus. It's also, in some sense, built a bit more of a frugal culture within the company, a bit more of a focused culture within the company, and I think people appreciate the long-term orientation of that kind of a decision. No one wants it in the short term, but it is the right long-term decision. And
would you say you guys are still operating under that kind of frugality, like no more kombucha? Or, sorry, that's a terrible joke. It's not even useful. It's mean.
I don't even know if we have. I don't know if we've ever had kombucha in our
I love kombucha, so
great. Well,
anyway, so no, I'm just.
When you come visit us, we'll get a special kombucha delivery.
I don't want to make it light. I don't want to make light of the layoffs. But are you guys still, frugal? Or?
I think we've always been focused on building what we call a real business. I mean, just one of the jokes internally we would say we're building a real business. And the company's been cash flow positive many times. We've always focused on maintaining high margins and so forth. And I think this sense of frugality, but also investing in growth. It's really like what you saw in 2022 was a lot of companies cut costs and just focus on getting profitable, but that impacted their growth. We've tried to find the middle ground of cost reduction, cost focus, but also really keeping top line strong. and then, most importantly, building the things that our customers need now and customers will need in the future. So we've seen a big expansion of our product suite over the past 3 to 4 years, and trying to continue that expansion in the way that is most true to our market and what our customers need.
I have something to ask you about that in 2 seconds, but before I do you think that all of that expansion is going to help you guys keep your valuation the next time you do have to raise money? Because I mean, I feel like the sort of valuation situation is not a great one. Like, are they prepared for that haircut that may inevitably come?
Look, I think the reality is our team...
You're still at 13 billion now, am I right? Or has it already been marked down?
As I said, who knows what the actual valuation is? The last valuation was at $13 billion.
Okay.
The way that we think about valuation, again, and we talk to our team about this a lot, is we want to be pragmatic to the realities of what's happening. Prices change over time, and they should change. What we value is kind of acceleration for our customers and delivering on the products and the customers that we need. And if we need capital to do it, we'll raise capital at whatever the appropriate valuation is, so long as we believe long-term in the right outcome. I like to say that I'm not egotistical about our valuation. Our valuation is what it is. We don't even determine it. The market determines it. I'm very egotistical about our long-term valuation. I care quite a lot about the long-term valuation, the 10, 20-year valuation. And if that means kind of taking steps along the way in order to get there, that's what we're really focused on. But again, we don't spend too much time thinking about it because we don't need capital. We're not raising capital. Just very focused on products and market.
Okay. So with that big expansion into products, you guys have done a whole bunch of interesting things. You've made acquisitions to kind of move into other areas as well. Cognito for was your most recent one. Okay. It kind of points to a very interesting thing. So I don't mean to bring this up, but Jamie Dimon, made this, called you guys a while back. I'm sure you know this. This is not a thing. He called you a data abuser, and you guys have, of course, had to do some class action suit settlements on data and so on. Maybe you could just tell me about what lessons have you learned from all that, and where are you going forward as you guys are building all these new products that you're talking about? How is that sitting with you?
Yeah. So look, we've been always very focused on building the tools that customers need. So the thesis is a consumer wants to use their bank account digitally. They need to apply for a loan, let's say. How do you connect your existing bank account into that loan application? Let's say you're applying for a loan at Lending Club, you have a Chase checking account. How do you connect those two? That's what we build. And the way that we think about our mission is we call it unlock financial freedom for everyone. We're focused on helping consumers live better, more differentiated financial lives by having access to all the products that they might want to use. Having better access gives them better rates, gives them...
So that's just the price that they have to pay to have all this better access, is giving up their data, or...
No, not at all. Not at all.
So where does the data figure in that, and how are you being a better custodian of it now, since you've had to do the settlement, you've had the high-profile accusations, et cetera?
Well, I think there's a few things in there to untangle. The first is we haven't changed our data practices. Our data practices have always been very focused on what's best for the consumer. We've improved, we've added features, so on and so forth. But the core concept of protecting consumer data, ensuring that consumers are getting access to the products they want while being protected on the back end, that's very core to us, both from a security and a privacy standpoint. So that's never changed. The philosophy has never changed. The products have certainly evolved. I think you have to keep in mind the different circumstances under which the things that you mentioned happened. First is we'd sold the company to Visa, and fairly quickly thereafter, there was a lawsuit attempting to gain value, you could say gain value from Visa, perhaps. So that is not an uncommon
They were sort
thing.
of like the proverbial ambulance chasers.
It's not an uncommon thing to see.
Patent trolls.
It's not an uncommon thing to see a lawsuit filed following a big acquisition. And that we did end up settling that, but really the focus there was...
So you believe you settled it just to get that stuff out of the way, not because you accepted that you guys had any bad data practices?
Yes. We can always improve our practices. We always are welcome to feedback, but we did settle it, yes, to get it out of the way.
And then what about Jamie Dimon then?
And Jamie Dimon's comments, we welcome. I deeply admire Jamie. I'm really impressed by the incredible things he's built over so many years. But the reality is we enable competition in financial services. We enable competition for the banks. And what you'll notice is, despite the fact that he did, yes, make some comments about Plaid early on, JP Morgan also invested in Plaid
Yeah.
later. JP Morgan became a Plaid customer. They became a large partner.
Friend of me.
Well, look, we try to work closely with everyone in the industry.
Yeah.
We're fortunate that we have very few competitors and quite a lot of partners and quite a lot of customers.
Yeah.
The reality is we were creating a new market, right? We're creating the foundations for a new market, which is fintech. And that ruffles feathers.
Right.
But in some sense, that's also a good thing. You want to be ruffling feathers when
Yeah.
you're creating a new market. Now, could we have done it in a way, would I have liked to maybe have a conversation with Jamie before he said that? Absolutely. But that wasn't the opportunity that we had, and so we've since grown a lot.
That sounds very intimidating. I think you're a tall guy. I think you might have intimidated him a little bit.
I don't know, he might be.
Okay, so you mentioned competition. We don't have much time. In fact, we have no time, but Stripe.
Yes.
I feel like they are the biggest elephant in the room competing with you guys, or do you see anybody else as a bigger threat?
I wouldn't say that. I think that Stripe has some products that do compete with Plaid, yes. And Stripe
Increasingly more.
I don't think more have been added recently.
Okay.
But they do have 2 products that compete with Plaid. And historically, we've worked closely with them as a partner, and they've kind of shifted their tack there, and that's totally
Yes.
their prerogative to do. But the reality is, we see most of our competition as kind of paper, frankly. Like, still many people walk into a bank branch with a shoebox full of paper in order to apply for a loan. Mm-hmm. We can fix that. So paper is one. There are some direct competitors that we've always had. But the larger pie that we think about is kind of enabling consumers to better have access to their financial products, and enabling consumers to better use their bank account for things like making a payment or so many other things out there. So.
Okay, cool. Thank you so much.
Of course.
We're out of time. Thanks, everybody.
Thank you for having me.
Yeah, thank you.